Have you ever wondered how multinational companies handle taxes across several countries and continents? Well, it starts with how the company price their products or services. Consider a company selling the same product in both New York and Nigeria. The question is, how would the company set the right price for the product in both locations? The answer to that lies in transfer pricing. In this video, we will unravel the complexities of transfer pricing regulations, delve into real-life case studies, and explore how Nigeria is safeguarding its tax revenues while ensuring fairness and transparency. Hi, my name is Olatunji Abdulrazak. I am the founder and CEO of taxmobile.online. Welcome to my YouTube channel, A Stitch in Tax Saves Cash. This channel is dedicated to helping you stay on top of your taxes. We will provide you with tips and strategies to help you keep more money in your pockets and minimize your tax liability while you stay in compliance with tax laws. So, if you want to start taking control of your finances from today, hit the subscribe button below and click the notification bells to stay updated on our latest videos. Firstly, what is transfer pricing? Transfer pricing is the setting of prices for transactions between related parties, such as subsidiaries of the same multinational company, to allocate profits between different tax jurisdictions. In Nigeria, transfer pricing regulations are created to ensure that transactions between related parties are conducted at arm's length, meaning they reflect the prices that would be agreed upon between unrelated parties in a similar transaction. Transfer pricing regulations are crucial to prevent profit shifting. This is when companies manipulate prices on transactions between related entities to shift profit to lower tax jurisdictions in order to reduce their overall tax burden. By setting guidelines for arm's length pricing, these regulations help ensure that each jurisdiction receives its fair share of tax revenue. The 2018 Income Tax Transfer Pricing Regulations in Nigeria provide a framework for determining arm's length pricing for related party transactions. The regulations require taxpayers to maintain contemporaneous transfer pricing documentation, use acceptable transfer pricing methods, submit country-by-country reports, and comply with advanced pricing agreements where applicable. Now, let's simplify things with some case studies. Case study 1. Company A multinational corporation, sells raw materials to its subsidiary Company B in Nigeria. Company A charges Company B a price significantly higher than the price for the materials, resulting in Company B reporting lower profits in Nigeria and higher profits in a lower tax jurisdiction. This manipulation of prices can be detected through transfer pricing regulations, leading to adjustments by tax authorities to ensure fair taxation in Nigeria. Case study 2. Company X, a Nigerian company, licenses intellectual property rights to its related party, Company Y, located in a tax haven. The licensing fees charged by Company X to Company Y are much lower than the fair market value, allowing Company X to shift profits offshore and reduce its tax liability in Nigeria. With transfer pricing regulation in place, tax authorities can investigate such transactions, adjust prices to reflect arm's length terms, and prevent profit shifting. In essence, transfer pricing regulation in Nigeria prevents tax avoidance through artificial manipulation of prices in related party transactions. Now, let's go over the requirements of the regulation. 1. Maintaining contemporaneous transfer pricing documentation. This refers to the comprehensive records and analysis prepared by taxpayers to support the pricing of related party transactions at arm's length. The regulation requires that this documentation should be prepared at the time of the transaction to demonstrate that the pricing was determined based on market conditions and would be applicable to unrelated parties. The components of transfer pricing documentation are as follows. Description of controlled transactions. This includes detail of the related party transaction, such as the nature of goods or services exchange, pricing methods, and contractual terms. Comparable analysis. Taxpayers must conduct a comparability analysis to demonstrate that the prices charged in related party transactions are consistent with those in comparable transactions between unrelated parties. Selection of transfer pricing method. Documentation should outline the rationale for choosing a particular transfer pricing method. Financial data. Providing financial data, profit margins, and other relevant financial information to support the pricing of related party transactions. Functional analysis. Describing the functions, assets, and risks assumed by each related party involved in the transaction to justify the allocation of profit. Proper documentation is crucial for taxpayers engaged in related party transactions for several reasons. Compliance. Tax authorities increasingly scrutinize transfer pricing practices, so maintaining proper documentation helps demonstrate compliance with regulatory requirements. Risk mitigation. By having thorough documentation, taxpayers reduce the risk of facing penalties, interest, and transfer pricing adjustments in case of tax audits or investigations. Transparency. Documentation enhances transparency by providing a clear record of how transfer prices are determined, thereby promoting trust and credibility with tax authorities. Efficiency. Well-maintained documentation streamlines tax compliance processes, facilitating quicker resolution of transfer pricing inquiries and disputes. Now, let us simplify things with simple case study. Case study 1. Company M, a multinational corporation with operations in Nigeria, enters into a distribution agreement with its subsidiary, Company N, for the sale of finished goods. Without proper documentation supporting the pricing arrangement, tax authorities may consider the prices charged by Company M to Company N as being below market value, leading to potential tax adjustments and penalties. Maintaining detailed transfer pricing documentation would have helped justify the pricing and avoided tax implications. Case study 2. Company P provides management services to its related party, Company Q in Nigeria. The fees charged by Company P to Company Q for these services are questioned by FIRS during tax audit. Due to lack of comprehensive documentation outlining the basis of determining service fees and demonstrating comparability with similar services in the market, Company P faces challenges in defending its transfer pricing practices. Proper documentation would have supported the arm's length nature of the fees and avoided potential tax assessments. Another requirement of the regulation is using acceptable transfer pricing method. In Nigeria, the Federal Inland Revenue Service recognized several transfer pricing methods for determining arm's length pricing in related party transactions. These methods align with international guidelines outlined by the Organization for Economic Cooperation and Development (OECD) and are applied to ensure fairness and compliance with transfer pricing regulations. The methods include Comparable Uncontrolled Price Method (CUP). This method compares the price charged in a related party transaction with prices in similar transactions between unrelated parties. The key is to identify comparable uncontrolled transactions, products, or services to establish an arm's length price. Resale Price Method. Under this approach, the resale price method by a related party for goods purchased from another related party is marked up to determine an arm's length price. The resale price method is commonly used in distribution or trading arrangements. Cost plus method. In the cost plus method, a markup is added to the production cost incurred by one related party to determine an arm's length price for the goods or services transferred to another related party. This method ensures that the selling party earns a reasonable profit margin. Transactional Net Margin Method (TNMM) compares the net profit margin realized by a related party in a controlled transactions with the margins of independent enterprises engaged in comparable transactions. It focuses on the profitability of the entire transaction rather than specific prices. Profit Split Method. The profit split method allocates the combined profit of related parties involved in a controlled transactions based on the contribution of each party to the value creation. This method is applied when it is challenging to determine an arm's length price using other traditional methods. Now, let's discuss the factors to be considered when selecting a transfer pricing method. Nature of transactions. Consider the nature or type of transactions, such as goods, services, or intangible property, as different methods may be more suitable for specific type of transaction. Availability of data. Assess the availability and reliability of data needed to conduct comparability analysis and apply the selected transfer pricing method effectively. Functional analysis. Understand the functions, risk, and assets of each related party involved in the transaction to choose a method that aligns with the value creation contribution of each party. Economic circumstances. Consider the economic conditions, market dynamics, and industry norms that may impact pricing decisions and the selection of an appropriate transfer pricing method. Consistency with OECD guidelines. Ensure that the chosen method aligns with the OECD guidelines and local transfer pricing regulation to mitigate risks of non-compliance. Now, let's discuss some case studies. Company X, a manufacturer in Nigeria, sells components to its related party company Y for further processing. To determine an arm's length price for the sale of components, Company X applies the cost-plus method by adding a reasonable markup to the production cost incurred. Therefore, Company X ensures that the transfer price is in line with market condition and avoid transfer pricing disputes. Company Z provides marketing services to its related party Company W in Nigeria. To determine the arm's length price for these services, Company Z and W apply the profit split method based on the respective contribution to the marketing campaign and revenue generation. By using the profit split method, both parties allocate profit fairly and comply with transfer pricing regulation. In conclusion, understanding transfer pricing is essential for navigating the complexities of multinational business operations and ensuring fair taxation across borders. By adhering to transfer pricing regulations and maintaining transparency in related party transactions, businesses contribute to a more equitable tax environment. In Nigeria, the income tax transfer pricing regulations provide a framework for compliance. In this video, we have been able to discuss two of the requirements of the regulation. Join us in the next video as we dive deeper into the remaining requirements of the regulation, which are submitting country-by-country reports and complying with advanced pricing agreements where applicable. If you have any questions or want to share your thoughts, feel free to drop them in the comments below. And if you find this video helpful, don't forget to like, subscribe, and hit that notification bell for more insightful content. Also remember to watch our previous videos. Thank you.